Hi, this is Rob Beardsley with Lone Star Capital, and today I'm talking about the differences between bridge and permanent financing. So, pre-COVID, something very interesting happened, right? We had a very flat yield curve, and for other reasons than that, competition between debt funds and generally in the capital markets, the pricing for bridge loans really compressed, and it was not too much more expensive to take on bridge debt than it was to get permanent debt from Fannie and Freddie, as an example. So since there was a minimal pricing difference, yet the leverage was often superior on bridge loans, as well as people were pretty sanguine about the capital markets and the future outlook. They felt comfortable taking on bridge loans, and there really wasn't too much of a perceived cost or risk associated with it. So a lot of sponsors were willing to take on bridge loans, and it was starting to loosen up and not being viewed as much of an additional risk. Now, however, post-COVID, we've seen some structural differences. So the securitizations market, the CRE CLO market, was completely dislocated along with CMBS, and that caused the pricing for bridge loans to go up substantially. And there are other reasons that bridge loans went up in price as well, but now we've seen a market where bridge loans are more expensive, substantially more expensive than permanent debt, because as fascinating as it is, the 10-year treasury came down substantially. So if you're getting fixed rate debt with the 10-year treasury yield as your index rate, now you're locking all in rates for less than 3% on 10-year paper. And comparing that to a bridge loan that you might get a 4.5% bridge loan, 5.5% bridge loan, these are tremendous differences in cost of capital, which should not be taken lightly. Additionally, bridge loans have become less competitive on leverage. Pre-COVID, you're able to get 80% LTC, maybe even 85% LTC in a stretch scenario. Today, bridge lenders are more cautious at 75 or even 70% LTC. And that's right in line with a lot of the leverage points available with permanent debt, either through the agencies or now CMBS is coming back. And so really, if you compare the all-in proceeds as well as the cost of capital, bridge loans are really now should really only be used in a must scenario, where the deal just cannot qualify for permanent debt for whatever reason. So I think this is a very interesting change in the market, and something that maybe not everybody is really paying attention to, and they still think, hey, I can get a bridge loan just like before, and it's not a big deal, it's not going to cost me as much, and I'm not really taking on much more risk. But I would argue that really, based on market dynamics and the future growth opportunity of deals, the best place you can be right now is locking in cheap, very cheap, long-term debt. Another reason for this is because of the more modest to negative outlook on NOI over the next 12 to 24 months. And this goes towards bridge lending underwriting as well. Bridge lenders are less credulous on value-add business plans anymore. No longer is it just so straightforward to go to your lender and say, we're going to go in there, spend $4,000 or $5,000 a unit, pop the rents $150, and then we'll be able to take you out through perm financing. That's no longer an easy story to buy because of COVID and the way that the economy has changed. So that puts more pressure on bridge loans, and it should be more pressure on you as well if you're contemplating an acquisition. How much do you really believe in your business plan? And should you be betting a bridge loan on that business plan? Sometimes you have to, and sometimes the pricing is compelling enough to take that risk. But I'd argue most of the time you're seeing deals are across the board fully priced, whether they're stabilized or they're unstabilized. Sellers, no matter what they're selling, whether they're selling a core asset in a premier location or they're selling a distressed C deal, they still really have top dollar in mind. And so it's not often the case that you're able to compensate for the risk through a lower basis in order to justify the bridge loan and the added risks of a turnaround play, for example. So in my opinion, with these capital markets dynamics in mind, and as well as the prospect for NOI growth through value add, really your best bet is to lock in long-term debt and pursue business plans that are more readily achievable, whether that's through straightforward expense decreases or proven out rent increases or other value creation. Thanks for watching.